Thank you, Ryan, and good evening, everyone, and welcome to the latest installment of AAII's Webinar Wednesday series. My name is Wayne Thorpe, the Senior Financial Analyst at AAII, and I'll be serving as tonight's moderator. The American Association of Individual Investors is a nonprofit investment education membership corporation that, for the last 40 years, has been promoting a mission of helping individual investors become better managers of their own assets through educational programs, research, publications, and software. These webinars are a natural extension of AAII's educational mission and allows us to reach a global audience. Tonight, I have the pleasure of introducing our speaker, John Bajkowski. John is the President and Chief Executive Officer of AAII. He is also one of the financial analysts at the association, writing extensively on, among other things, stock screening and stock analysis. John also serves on the advisory committees for both AAII's dividend investing and stock superstar services. Tonight, John will be discussing AAII's model shadow stock portfolio. To me, the shadow stock portfolio best encapsulates one of AAII's primary goals of taking reasoned academic research and translating it into actionable investment strategies and processes. The shadow stock portfolio is a microcap value portfolio designed to capture the small cap and value factors that have been shown over a long period of time to outperform the broader market. Not only does the shadow stock portfolio provide clear-cut quantitative stock selection rules, but is also a complete portfolio management system. As such, there are concise guidelines to help users build, monitor, and manage their portfolio of microcap value stocks with a minimal time commitment. John has a wealth of information to share with us this evening, so without further ado, let me welcome in John Bajkowski. Good evening, John.
Well, thank you, Wayne. Thanks very much for your introduction. Those are kind words. Appreciate them.
My pleasure. We hadn't really talked about what we might be chatting about previously, but I think I know you're a baseball fan, so are you looking forward to the start of the baseball season tomorrow night?
You know, I am, although it's a challenge because being here in Chicago and being a Comcast customer, the Cubs have not reached an agreement with the new marquee network to watch the Cubs game. Of course, fortunately, I'm still a Sox fan as well, so I'll be able to watch at least the Southsiders.
That's right. We got that friendly rivalry going on because me being a lifelong Tigers fan. But yeah, it's good to see that we have some things returning back to normal a little bit. But
I agree. It'll be interesting how a short season will play out. You know, normally in a long season, the odds win out. Statistics like the shadow stock portfolio, long term win out. Short term, who knows who's going to win?
Exactly. You get a pivotal injury at the wrong time that could really have a significant impact. Where if you have a 182 game season, that definitely the things can average out. So it will be interesting to say the least.
Very much, I agree.
Well, John, I will leave it to you. The floor is yours.
Well, thank you. Thank you so much, Wayne. You know, Wayne really did a wonderful introduction to the shadow stock portfolio. And really, the beauty of the shadow stock is it's an experiment. And it's an experiment that tries to take the best research that's out there and try to codify it in a way that we as individual investors can follow. And it started off as an experiment by Jim Clunan back in '93. And the rules have evolved over the years. And it really proved to show us, educate our members in real time, how one can take a interesting quantitative research-based approach and apply it in the real world. And I'm going to share with you tonight the genesis of some of the concepts behind the rules were chosen for the shadow stock portfolio, and also take a look at how one can execute some of those rules and where you as individuals might have some advantages, and also how when you follow an approach like this, an approach that has a good long-term track record and is based upon long-term trends, you have to understand that it isn't always going to be smooth sailing. So that's going to be my goal tonight. And so if any questions come up, please pop them in the questions panel. Wayne will be there listening, and he will alert me to any kind of key questions that come up in case anything needs any further explanation. So really, what we're talking about here is trying to invest in an area where you as an individual have an advantage. And that's the whole notion of what we've been looking at the association. And one of the advantages that you have as an individual is that you can invest in micro cap stocks. These are very small cap stocks. and I'll talk about these later, but even mutual funds that call themselves small cap funds often are really not really micro cap. And that's where really the best performance long-term has been. And you can invest in them. You're not going to move the markets. And on top of that, you have the flexibility of waiting. If you're a mutual fund and you have redemptions, you're going to be forced to sell. You're going to be able to control your tax situation. So as an investor, and one of the reasons why you might want to invest in a portfolio of stocks you manage yourself is you have complete control over the timing of the decisions. You don't have to worry about underperforming your neighbor and trying to look like the market, trying to be a closet indexer. You could take a long-term approach, a truly long-term approach, and wait for that approach to work to your benefit. So the primary factor that the shadow stocks are based around is that of market cap. Market cap, very simply stated, is simply the share price times the shares outstanding. And it's one of the most popular measures of company size. Things like revenue can also be used. But really, this is the sort of the common one that's used. It reflects, in a very basic way, the public's consensus view of how much a stock is worth. And the thing to think about is the marketplace is emotional. At times, they get very excited about companies and they bid the stock price up and the market cap up. At times, they get pessimistic and they bid that market cap down. But it's a good basic measure of how much a company is worth. And looking at the fundamental information that led to the work of the shadow stock portfolio was looking at, and it was a small cap effect, is the notion that equities offer a great long-term rate of return. And they offer better returns than bonds. But even within the equity world, if you're willing to put up with a little bit extra risk, there is the potential for better long-term rates of return. Now, when we talk about the S&P 500, which is a market cap weighted index, really we're talking about the largest 9/10% of stocks. Let me just take a step back here for a second. So when we're talking about market capitalization, and you take the largest companies down to the smallest companies, we're talking about publicly traded companies. In fact, we're talking about companies that are listed on the New York Stock Exchange. And you take the smallest to largest and you break them down into 10% bands, largest 10%, the next largest 10%. These are called deciles. So the S&P 500 primarily represents the largest 20% of companies that are trading in the US. And we take those market capitalization ranges and then apply them across all exchanges. So long-term, S&P 500 has returned about 10% from 1926 to 2018. Now this chart, I wasn't able to update this chart. Unfortunately, our source for this chart is the Duff & Phelps Morningstar SBBI book. And this past edition, for one reason or another, they switched from using the deciles and showing deciles to simply using a proprietary Morningstar return. So unfortunately, I haven't been able to update this chart, but it gives us a good long-term feeling. When we talk about the S&P mid-cap stocks, those are really that pinkish band, the third, the fourth, the 10th decile companies that are trading in the NYSE, but then they go across all ranges. The largest company here is a 13.5 billion company, and then the smallest one is about 3 billion in size. So in the S&P 500, you're going up to trillions of dollars, and in the mid caps, anywhere from 4.5 billion, 3 billion to about 14 billion. And then the small caps, when you talk about the S&P small cap 600 or most small cap funds, they're trading in this blue band, which are the decile wise 6th to 7th decile, 6, 7, 8 decile. And a lot of companies are actually listed in this size. The number of firms that make up this group is pretty good size. In terms of market cap, they only make a small percentage of the overall market cap of the US area. And again, typically speaking, long term, as you go down and look at smaller companies, your long-term realized rate of return starts to go up. But what also goes up is the volatility. And that's the price you pay. That's why this extra return exists. Because year to year, it's going to be more volatility as you go into smaller companies. The largest band, we're calling the 9th, 10th decile band here, are where we start to look at small companies. These are companies, in the case of the shadow stock, looking at the lowest 10th decile of size. Largest company at the end of 2018 was 300 million in size, 312 million in size. That's the size, this upper size limit of what we're looking for in these micro-cap stocks. So as a mutual fund, as an institutional investor, you cannot invest in anything that large, anything that's small. You're going to basically, you can't buy enough positions to make up your portfolio. Now, what you see then is long-term, that group has outperformed the other strategies by a pretty good margin. But the thing is, it's come with much greater risk. And that's the trade-off that happens. The other thing to note, and this doesn't really show up too well on this slide, is that when it comes to rates of return year to year, most rates of return year to year when it comes to stock markets are sort of random. What you did one year is, statistically speaking, not predictive of the next year. But that doesn't hold true in the world of small cap stocks. What they found in the world of these micro cap stocks is there is a bit of serial correlation where what happens in terms of return one year has some impact, some predictive value to the returns next year. So what happens often with small cap stocks is they have runs. They have hot runs, they have cold runs. Those are things you want to be aware of when you're investing in this strategy. The other point that this is actually a interesting notion to keep in mind is what impact time periods have on your rate of return, your performance. And this is a slide that came out of the latest Ibbotson book, in this case, the Morningstar Duff Phelps SBBI book. And they looked at the performance of small caps versus large caps, what percentage of the time they tend to outperform. Now, if you go back to 1926 through the end of last year, you look at monthly holding periods, it's about 50-50. Any given month, small caps, large caps can outperform. But once you start looking at longer term holding periods, 5 years, at 5-year level, going back that far in time, small caps outperform large caps about 56% of the time. 10 years, 68%. Over 20 years, the holding periods, these are rolling 20-year holding periods, 88% of the time. If you look at 30-year holding periods, that they outperformed 96% of the time. Now let's look at that in reverse too. That also means that even a long-term holding period, you could have held these stocks for 30 years and still had small caps underperform large caps. There's no guarantee of outperformance. The odds are stacked in your favor, but there's no guarantee that these small cap stocks will actually outperform. There's just a good probability that they will. And the other two columns here on the side show what the percentage of outperformance has been since the 2000s. And for the most part, everything's have held up. The percentages are roughly the same. In fact, small cap stocks did much better in the first 10 years, and large cap stocks have done better in the second 10 years. But all in all, small cap stocks, even over this time period, have outperformed large cap stocks. So really, what we're talking about here in terms of the shadow stock, in terms of the investable universe, it's the smallest 10% of market cap as defined by the NYSE. And right now, in terms of creating a rule, now we're taking these rules and trying to create quantitative rules we could use to manage our portfolio. So when it comes to the shadow stock, we first include a stock in the shadow stock. Our maximum ceiling of market cap we'll consider is 300 million. And when this thing started back in 1993, our actual cutoff was 55 million. So the markets have gotten larger as far as market cap over time. We've been at 300 for now since 2013, and so it's been our upper cap for some time. Now, other consideration though, when you start investing in microcap stocks, this is one of the things we discovered when we put this portfolio together, is that you also want to be careful about making sure that you don't have junky stocks in there. So we're not looking at OTC stocks. These are not bulletin board or pink stocks. We're also specifying a minimum floor of at least 30 million in market cap. We want to avoid stocks that are too small, in danger of being delisted. In fact, we're looking at even stocks that have a minimum share price of $4. And we also want to be careful about liquidity. This has become less of a problem over time, but sometimes these smaller micro-cap companies don't trade a lot. You know, if you go to buy or sell some shares of Microsoft, you know, you could be guaranteed you could put an order in and it's going to execute quickly at a fair price. There won't be a lot of movement. When it comes to some of these small cap stocks, you go or buy to sell them, what's going to happen is the price might start to move because you want to take, let's say, even a $10,000 position. There only may be 100 shares available to purchase at that price, and then the price may start to creep up. So we recommend using limit orders to help control, make sure you don't get slammed by having a bad fill with your orders. So what else have we found out? So again, we were looking at how to apply really well-known academic studies. So we looked at shadow stocks. These are small company stocks that are in the shadows of Wall Street. What else was out there? Well, what measure of worth or value? One of the ones we use fundamentally for shadow stocks is price to book. And price to book value, or book value, really is simply assets less liabilities, called shareholders' equity. And it kind of, in this case, doing price, which is the overall market's assessment of how much a company is worth, relative to the accounting value of a book of a company, is what price to book is. And one thing to note, though, is that all the academic research that looked at these factors typically ignored financials when it came to looking at price to book. And the problem there is that their financial statements are not comparable. So unfortunately, also when it comes to the shadow stock portfolio, we've excluded financials because that's what really, you can't compare them in the same way as you can compare other types of companies. Now, price to book is an accounting measure. Now, the problem is that, nowadays, not everything that is of value in a company may appear on book value. It's an accounting measure. A lot of intellectual property, the value of the company's, the workers, may not appear as an accounting measure. So that's the weakness of of book value. And also, if things have been depreciated, if you're an industrial company and you've depreciated the assets, the replacement value may be different than what the book value is. And the other thing that we've come across as far as a weakness with book value, or something you have to keep in mind, is that when a company repurchases its shares, and it actually will often reduce the book value in the process. A company like Home Depot, I think, is actually close to negative book value, if it's not negative, because it's repurchased so much of its shares, and it's actually decreased the accounting value of its financial statements. So there aren't, it's not a perfect measure, but it in the case of how we've seen as far as historical studies go, it's a very strong measure. So it works on average because it's close enough estimate of economic value. And again, studies have shown that the smaller the market cap, the higher the future return, but it tends to work well with book value as well. So it worked independently and worked well with other factors. In fact, the studies that were originally out there, and the studies that really helped determine the initial rules for the shadow stock portfolio, showed that price to book was a better value predictor than price earnings ratio. And this is really, this table has a lot of data to it, and all these slides are available for you to download, and they're available to you when we send out our email tomorrow. But this is really the table that kind of encompassed where the shadow stock is and how it was, why it was created. It basically represents this yellow intersection in the lower corner here, as basically as the deciles of price to book stocks get lower, the higher the returns get higher, and as the companies get smaller as far as size, the returns also get higher. So with the shadow stock portfolio, we're trying to capture that intersection of deep value and small cap. Neglected stocks. Again, these are stocks that are largely neglected. Many of them are not followed by analysts at all. So when it comes to the shadow stock portfolio, we adjust these measures over time, but basically we're looking at capturing companies that have a maximum price to book of 0.9. The original cutoff back in '93 was 0.61, and it's varied over time. In fact, I have a table later on to share with you that will give you the rates, the various levels over time. We had a cutoff of 1 from June of 2015 to last October, and we lowered it to 0.9 back in October. And as a point of reference, the S&P 500's price to book currently is a 3.53, and a year ago we were roughly the same level, 3.50. So we rank our stocks when it comes to buying them at price to book. We're looking at really deep value, and we're looking at stocks that are small cap and kind of neglected. What else have we done? Well, as we were running this portfolio over time, Jim Coonan discovered that there are other measures that could be helpful. In fact, he was highly influenced by O'Shaughnessy's work. And at the time, O'Shaughnessy felt that one of the best factors to use, in fact, the original O'Shaughnessy book regarding this kind of analysis showed that price to sales was really the best strategy to use. And why? Well, for one thing, versus say earnings, price sales are not influenced by many of the accounting measures that might impact book value, and even earnings. So it can be meaningful when earnings are negative or book value is negative. So it's applicable to a wider array of companies that actually have sales. But the problem that I found personally with price to sales is that you can't just screen at price to sales looking at low levels, because price to sales, companies that have high profit margins typically trade and deserve to trade with higher price to sales ratios, because they take every dollar of sales and convert them into a greater, higher dollar value of earnings. So in my personal opinion, if you're going to screen for price to sales, you're much better off looking at a relative price to sales ratio relative to the industry norm. So what we do though in shadow stock is we cut it off at 1.2, and there is a risk that we might exclude certain industries all the time. So that's something worth taking a look at for us in the future. These rules have been changed over time as we've modeled these portfolios. So this is one that might be due for a examination as well. One thing to keep in mind, so our filter is 1.2. A company's price to sales ratio must be less than 1.2. It was established back in '96, so a few years after the portfolio was established. The original cutoff was 0.54, and for a while there, Jim was modifying this approach up and down, but really it's been stable at 1.2 since 2003. And if you want to read more about price to sales, I mean, the pioneer with the price to sales ratio was really Kenneth Fisher, and the book Super Stocks talks a lot about how to use price to sales as companies progress through their levels of growth and expansion, and what numbers are relative to an expansion company versus a company that's more mature. Other articles have taken a look at price to sales, such as the Financial Analyst Journal article and What Works on Wall Street, which covers a ton of strategies, including price to sales. So when we're talking about the shadow stock portfolio, today we're looking at, there's a couple of columns of data here. The first column gives us if you look at what drives our decisions as far as what to make cutoffs for market cap and price to book. So right now, today, I did a screen. If you looked at the NYSE stocks only, the lowest 10th decile stocks, the highest market cap that would pass is 212 million. And that kind of dictates what we're looking for as far as our market cap for the shadow stock. That's why our rule exists. If you look at the decile of the NYSE stocks as well, what is the price to book ratio for them? The highest price to book that's valid for US stocks is 0.70. And that's actually a little bit lower than what we have, but we want to make sure there's a margin to buy some stocks to go in. In fact, at times we've let the level go float a little bit higher to make sure there's enough candidates available. And again, the other ratio that we want to make sure that a company possesses is a price to sales ratio of less than 1.2. So other considerations, I mean, it's not enough to be small cap and low price. We also want to make sure that the company has positive earnings. And initially that wasn't a rule, but it's a minimum quality rule. So, and when available, we also look at consensus estimates. We want to make sure those are positive as well. Other things we've done over time, we were finding there were a lot of stocks that were passing 1 year, then they'd have a little bit of negative earnings. We'd sell them, we'd buy them back a year later. They were coming on and off the list of shadow stocks. They weren't performing very well. So really, Jim instituted a rule that we're avoiding any stocks that were sold in the last 2 years. And again, since many of the stocks are being sold for negative earnings reasons, that was kind of to help avoid those marginal companies. What else so important, we're avoiding any stocks that aren't listed in the US. And also we're avoiding Chinese firms. Now, there's nothing magical about that, but we were finding the candidates that were passing had really financial statements that were comparable. These are really small companies. They're not the well-traded, well-followed stocks. And we were coming across a couple of companies that were just having issues as far as their financials and timeliness. It was best to avoid getting entangled in those difficulties. The other issue with foreign stocks is things like withholding of dividends, taxes on dividends. Also, we're avoiding financial stocks. Their financials are different. Lease companies, REITs, limited partnerships. Again, their financials are so different that it's not really comparable. Their book values aren't comparable to other kinds of companies. And also, we're making sure that a company has filed a quarterly statement in the last 6 months. That's the case when we add them. Occasionally we have situations where companies are shadow stocks and they're a little bit late as far as filing. We typically hold them until they actually do declare their, provide their statements if there's a valid reason to do so. Things to keep in mind, and I'm not going to get too much in the weeds. I have some slides here for you to take a look at later on in your own. Is that, you know, be cognizant of buying in and moving out of these stocks. It's very often, if you look at the market environment, don't place trades, right at the open. Wait for the markets to get moving a little bit. Look at what the bid-ask spread is. So it's better off to take a look at doing smaller trades, especially nowadays with commissions being zero. It's better to get partial fills and trying to get in at once. Take your time to move in and out. You don't want to distort the price. A bid-ask spread might start to move on you quickly, so you want to take your time getting in and out of those trades. And often limit orders are really a desired way to move in and out. Here's an example we simply show you. We recommend that if you hold no more than 10 times the minimum daily volume. If a company has an average daily volume of about 300,000, you want to do a $5,000 position, that would be your that's how much you could afford to invest in that stock right now. So again, these are some rules. I'm not going to get over them. They're available on our website. We've got resources available to you later. The key point here, though, is that when you're building a portfolio, is you want to make sure you have at least 10 stocks if you want to try to capture the effect of this. In fact, the less research you do on these individual stocks, the more important it is that you hold a wide array of them. Often the shadow stock portfolio has about 30 stocks in there. That's been our average over the long term. So when these academic studies are done, they're pointing out, they're building portfolios of many hundreds of stocks. So you're not doing individual company analysis. You need a large number of companies to diversify, but also to capture the effect of this factor you're looking at. So we recommend a minimum of 10. And these rules were given more out of a function of liquidity. Again, nowadays, it's so easy not to deal with transactions. I typically just go ahead and buy the whole portfolio if I were to execute this, but at a minimum 10, 15 gives you good diversification, and if you're investing over $1 million, at least buy 25. And we recommend that you try to buy equal dollar amounts in these things initially, and think forward as to how much you're going to have. If you're going to build a portfolio of $100,000 and you're going to have 10 stocks in it, you want to, in effect, average out $10,000 in that position to get there. So really, that's the considerations as far as building the portfolio. Knowing when to sell. Now, that's just a critical part here. Really, when it comes to me as an investor, and I'm sure you guys do have the same issue, is it's so easy to find ideas. They're coming at you all the time. A lot of stocks. We publish a ton of screens ourselves at the association. Really, it's always easy to find ideas, and the problem is that certain biases come into play once you own a stock. You start to love your positions. You're afraid of telling people, that you've done bad. As far as, I know, you always share gladly your winners with your friends, but you typically hide those losers from your friends. So there's a tendency for investors to really sell their positions too quickly, and because they made a win, they want to prove it to themselves, and they typically hold on to their losing positions way too long. They wait to basically go out and get even. And what would happen, though, is that we understood those kind of difficulties we have as investors, so it was very important to create some sell rules to help overcome those emotions. And you want to try to find out if there's better opportunities out there now. So we have things like a 4-year rule in the portfolio to help find new opportunities, and also balancing. If all of a sudden, if you have money to add to your portfolio, consider adding it to the stocks that are underweighted that are still attractively priced. And also, if you want to pull money out, you may be better off pulling money out of some of the stocks that are perhaps overweighted, dramatically overweighted as far as your portfolio is concerned. So when it comes to the specific shadow stock portfolio sell rules, we want to make sure that when we buy these stocks, they're a deep value, but we want that give them room to run for positive reasons. So we want to make sure that we may buy it when it has a price to book of less than 0.9, but we're going to let that price to book expand 3 times that level before we consider selling it. So you want your winners to run a little bit. So, and we only sell it if we could find an attractive, suitable replacement for it. The same is true for market cap. So market cap, right now, our maximum that we consider for including is 300 million, but we let that market cap run to 900 million before we sell it. We let it get into, almost get into that mid cap range before we consider selling it. We also sell for negative reasons. So if a stock, if a stock has negative earnings, this rule kind of grew over time. So what happened is that, and we also look at adjusted earnings because so many companies nowadays are taking constant little write-offs or adjustments. And we typically look at what's called the adjusted earnings that your broker will probably have, or if you look at an earnings estimate service. And so what happens is that based upon our, wanting to keep our transactions at a minimum because turnover is very costly in the microcap arena, is we wanted to make sure that if a company has negative adjusted earnings over the last 4 quarters, that it is not just a short-term blip that caused that level of earnings. So we instituted a probation rule. So if a stock reports quarterly earnings and it's negative, they go on probation. If in the following quarter, the quarterly earnings are still negative, we then sell it. Now, the important thing here to consider is that, when Jim was looking to set up these rules for the individual investor like you and me, is that microcaps are costly to trade, and he was not a big believer that price should dictate our actions. And so he set up a process where basically, when it comes to selling and it comes to portfolio review, all the academic studies are looking at like 1-year holding periods. What drives pertinent information for these companies? It's their quarterly earnings cycle. So the review cycle for the shadow stock portfolio is quarterly. So once a quarter, we're really looking at this portfolio in great depth, looking at how the earnings stacked up, and then making a decision if it's time to sell a stock. So really, the important thing here is you don't want to churn these stocks too much. The other rule that we done is the stock, this rule has kind of come on and off our rules over the years, is if a shadow stock has been held for 4 years and it's not up much anymore, if it's less than 10% gain, we're going to sell it if there's a suitable replacement. We want some turnover, some fresh life. So the key here is that you want your winners to run on both price to book and also as far as market cap. But if there's something negative and it comes to earnings, go ahead and sell it. And also, if there's better replacements available for you, go ahead and sell it. So again, it's typically we'll once we're just quarterly. We've had mergers over the years. Use your best judgments. Typically, if you have a merger, if the price largely reflects what the buyout will be, why hold on to it at that point in time? Typically, that's sold. And when it comes now time to, if you have a lot of candidates to consider, look at things like lower bid-ask spread, make sure there's plenty of liquidity, look at the relative strength ratio. So really, don't trade too often. Don't have to manage this portfolio too often, because when it comes to a microcap world, if you trade too often, it's going to hurt your performance, and you're not necessarily going to gain from that close monitoring. And then if you sell a stock, we try to keep our average position size in play. So we try to basically go ahead and buy, and you should do the same thing, roughly equal amount. If you need to, you can keep 5% of your portfolio in cash. And then if you have a lot of extra cash, let's say you sold a big winner, you have a lot of money to distribute, and there aren't enough candidates to buy, don't want to hold more than 5% in cash, but take a look at what you own as far as your other holdings, and if things are still attractive on a price to book, market cap, earnings, price of sales, reinvest the money there. That's what we've done as far as the model shadow stock rules ourselves. Now, let's look at performance. This is what the shadow stock performance has been year by year. There's a log chart here, and long-term performance going back to 93, the shadow stock has done very, very strongly. It's had a return of 12.5 annualized. This is through yesterday. And so rate of return has been great long-term. It's outperformed a number of years, outperformed the S&P 500 as measured by the VFINX, the Vanguard Index 500, which had a rate of return of 9.6 over those many years. It also outperformed what is kind of that, not the micro cap index, but the small cap index. Now, what we've also observed is that over the last 10 years, at least 7 years, really micro cap and value stocks have not done as well as large cap growth stocks. Even this year, the winners this year are your larger cap companies that are really holding up very strongly against the coronavirus stay-at-home market, where people are all of a sudden not really going out and spending money with small companies, small stores. Instead, their companies that are doing well are your large cap technology stocks who don't have low price to book values and are typically larger size. So long-term, the performance has been very strong. But again, as an investor, you really need to understand that right now, because the large cap stocks have done so well over the last 6, 7 years, 10 years, and on a relative basis, small cap stocks have underperformed, the relative value of these small caps have become much more attractive. Now, there's no guarantee that they'll turn around immediately, but they say, and I think Mark Twain perhaps said that history does not repeat itself, but it certainly rhymes. So we've had long-term trends before where small micro caps have underperformed. They've typically reversed, and one of the reasons why the strategy works long-term is twofold. One, it has more risk than large caps, but two, small cap and value go through periods of underperformance, and that tends to push people out. The last time I remember feeling this way was back in the 1990s. The 1990s, again, dot-com bubble era. If you were a value investor, it was a tough time to be believing in that. And if you switched and bought into growth right at the end of that cycle, right around 2000, that was a terrible time to switch because you basically got whipsawed. And all of a sudden you invested in a growth market that fell apart. Whereas if you have a balanced approach, or if you stuck to your guns, you would have benefited from that change in direction. So really, it's important with shadow stocks and microcap stocks is to have a long-term perspective. Microcap stocks, they tend to have consecutive periods of overperformance and underperformance. There's zero correlation. What else? They have more volatility, so it's important to have a diversified portfolio. Shadow stocks may not be suitable for your complete portfolio holdings, but if you're looking to have an equity booster, they are probably a good way to diversify against your large cap holdings, as well as bonds, as well as international holdings. Keep your expectations reasonable, and again, you as an investor have the advantage of being able to take long-term positions and sit out some of these periods of underperformance and benefit from some periods of longer-term outperformance. But when it comes to, you have to have a long-term perspective. You really can't just worry about making sure that how they did this year. When it comes even to stocks as a whole, stocks versus bonds, they've had periods over 20 years where they underperform bonds. Yet long-term stocks make sense, and that's also true for small cap stocks, I believe. So to succeed with the shadow stock approach, you need enough time to manage a stock portfolio. It's only, granted, it's only 4 times a year minimum, maybe a couple hours over the course of the year, 8 hours or so. But still, if you're managing a stock portfolio, it's important that you do keep a look at it, that you do actually take the time commitment to see how that portfolio is doing, how those stocks are doing. So really, if you have the time, Jim said, you can even review it monthly just to keep on top of things. But you cannot simply, it's not a mutual fund. You could buy it and forget it. You have to manage it as any kind of stock portfolio needs. So really, and you have to stay in tune with it, whether it's good or bad. The market's downturning, and you may want to avoid looking at your portfolio. It's still important to look at your portfolio, and you need a discipline. I mean, that's the biggest difficulty when it comes to any kind of investment approach, whether it's stocks as a whole or microcap stocks, is having the discipline, the faith, that understanding that, you know, when it comes to stock market, the stock market is going to have good runs and bad runs. It's going to have typically a year where it drops 10%, a bear market every 3 to 5 years, potentially a colossal, terrible bear market, you know, 3-4 times in your investing life. If the worst thing you could do is panic and go ahead and sell at the bottom, but also that works on the opposite side as well. You don't want to panic and buy at the very top, jump in without thinking about that, because you want to keep up with everybody. So it's important to really keep your emotions in check, and also to control turnover when it comes to microcap stocks. Wayne, I have some resources I could share with the members here. Should I answer some questions, or share some resources first?
We've got a steady stream of questions coming in, so we definitely have questions to ask. Hello, I realized I didn't show up earlier, so hello everyone. I think we definitely have a lot of questions coming in, so I think probably we could take some time and jump right into those right now if you want.
Let's do that. We'll answer some questions, and also in the handouts and slides, if we have time, I'll go over them as well later on. I'll point to where you can go ahead and find information about shadow stocks on our website and whatnot. So go ahead, Wayne. Hello, Wayne?
Yes.
Sorry, it froze for me on a second there.
Oh, that's okay. So actually, when several questions come in about, I think it was slide number 6, when you had the different deciles, the breakdowns,
sure,
amongst the different market caps. Andrew actually asked, why don't the deciles that you're showing in slide 6 have roughly the same number of companies in each? I think you might just want to how those deciles are broken down, just a little better. Just a little refresher of how these deciles are calculated.
Sure. Well, the number, okay, the deciles are determined by the stocks that are listed on the NYSE, New York Stock Exchange. So the decile, the size for each band is determined by the stocks that are listed on NYSE, but then those size ranges and those price to book ranges are then applied to all other stocks that are traded on the American Stock Exchange as well as the NASDAQ exchange. So they're not equal here, because the original decile bands, the size that are used to determine what the greatest, biggest, and smallest decile of market cap that will be. So let's take this first example. Let's go ahead. Let's use the 10th decile. So the 10th decile, we took a look at the stocks that were traded on the NYSE, and the highest, largest stock we would accept in that particular decile had a market cap of 312 million. We then look at all publicly listed stocks, whether they're NYSE, American, or NASDAQ, and we then apply that size range against those companies.
Okay. And actually, Russell had a follow-up to your slide number 6. When you're talking about, quote unquote small stocks as well as more microcap, which deciles specifically are those?
Well, when it comes to the small cap, here we're looking at really deciles 6, 7, and 8, and the microcaps are 9th and 10th. And the shadow stock is basically looking at that 10th decile.
Excellent. And actually, Robert had one other question regarding to slide number 6. And he says, I might have missed it, but what is the connection or the correlation between market cap and volatility?
I'm not sure if there is one specifically mentioned. I couldn't tell you if there. Well, market cap. I'm sorry. Market cap. Yeah. If you look at volatility, the this column here presents volatility as measured by standard deviation. And as companies start to get smaller, the year-to-year range between highest and lowest rate of return starts to increase. So normally speaking, smaller companies typically have a wider dispersion along a bigger tail. Now, the thing to note that standard deviation assumes a bell curve. Really, we know that the stock market itself has longer tails than a normal bell. So what happens is that there's a lot more volatility with small caps. And think about it this way. If a bunch of people holding a portfolio of these micro cap stocks run for the door at once, there's not going to be that many buyers around help support that stock price. What will typically happen is that stock price will fall much more quickly because there's fewer buyers around. The same works on the opposite end. If all of a sudden people get really excited about a company and it's a small cap company and there aren't that many shares outstanding, that price is going to bid up much more quickly than say a Microsoft. If I go ahead and try to buy, 1,000 shares of Microsoft, it could have no impact on the stock itself. If I do the same with a micro cap company, it may very much push that stock price up. So normally speaking, the smaller the cap, the greater the year-to-year, day-to-day volatility. And that's how you are able to obtain, if you have a long-term horizon, that volatility provides you that longer-term rate of return.
Excellent. Thank you very much. A couple questions came in regarding the adjusted earnings, and Dario actually asks, how do the adjusted earnings used to determine when to sell based on earnings differ from GAAP earnings? So basically, the difference between adjusted and GAAP.
What happened was, when Jim was running this portfolio over time, and it's probably in our sell rules area, he found that a lot of companies would report one-time elements. They might sell off a division, or they might have a small negative thing. In fact, today I think I remember reading that Texas Instruments reported earnings today, and they had a big boost by a one-time event that didn't impact GAAP earnings. It was a kind of a one-time addition. It boosted their earnings up. Also, there was negative things that occurred. So what happens is companies will also typically report adjusted earnings, as will services that provide earnings estimates. So if you look at a service like IBIS, which we use, or if you go to your brokerage account, chances are they're going to have a page that has earnings estimates on it and a record of past earnings, and they'll have an adjusted earnings figure there that tries to take out these one-time positive things and one-time negative things that aren't really part of the normal company course of running business.
And actually, Michael has a follow-up. Where do you go to find these adjusted earnings, since these aren't things that are normally you're finding in a 10K or 10Q?
Yeah, I typically go to my brokerage website, and I do my personal brokerage account. I also have accounts at the association, whether it's Schwab or TD Ameritrade or E-Trade. They almost always have a research stock page that has a record of past earnings, and there will typically be the actual reported earnings, the earnings estimate, and an adjusted earnings figure there.
Excellent. So getting to a few questions regarding portfolio creation, sort of hand in hand. Tyler asks, I don't want to manage a portfolio of roughly 30 stocks. So how do you suggest I go about selecting a subset of the shadow stock portfolio?
If you don't want to manage all 30, you typically, what you're going to want to do is you're going to want to start off with companies that have lower price to book and lower market cap figures. If you look at the current holdings of the shadow stock, many of them are past the initial limit now. So again, I would start off with companies that have positive earnings, are lower in the range of price to book and low market cap, and also pay a little bit of attention to diversification. You don't want to necessarily pick, all 10 stocks in the same industry. But again, I understand the limitation of not wanting to track all 30. There's not much of a cost issue, and even there aren't that many transactions that occur. You're looking at the portfolio, 4 times a year, and our portfolio turnover rate's been pretty low.
Excellent. And actually, Nolan has a sort of a follow-up question. Currently, there's only one shadow stock that meets the current, current shadow stock in the actual tracking portfolio that meets the current selection criteria. In those instances, and I think this plays into the patience element that you talked about towards the end, is, how do I, based on only having one passing company, how do I build a portfolio of shadow stocks?
Yeah, it's a challenging situation right now. I think what's really hurting the passing companies list more than the market cap or more than the price to book thing is the requirement for not only positive earnings historically, but also positive earnings estimates. We are now in a recession, and a lot of these companies, small cap companies, have been impacted rather strongly, and a lot of uncertainty as to earnings going forward. So I would again look at companies that are on the lower range of market cap, lower range of price to book, and have still positive earnings as my primary criteria for building new. And we'll probably need to take a look at the portfolio rules to see if we need to make any adjustments during the current market environment.
Excellent. Miguel asks, if I'm looking at 2 shadow stocks, considering I only have the ability to purchase one, if you're faced with that type of a situation, are there any type of tiebreakers that you use to decide to pick one over another?
There's a couple of tiebreakers we typically use. You could use lower price to book if one is lower price to book than the other. The other rule that we've worked with over the last few years has been market momentum, price momentum, where for a while there, I know that we even tried making that one of our considerations for the portfolio, is taking a look at how well the stock is doing recently. So if you have two stocks that are roughly similar in other characteristics, and one has better price momentum, you would typically probably want to maybe consider that one, only because the market itself sees something attractive about that stock, and it still has the positive financial qualities of having positive earnings, low price to book, and low market cap.
And this sort of actually, you just touched on, financial quality or whatnot, and I think this ties in well with a question that we got to from Hugh, is why do we actively exclude OTC stocks?
Well, the primary reason to exclude OTC stocks is that you don't always have good reporting of information. To be listed on an exchange, there are requirements as far as making sure your financials are current, making sure that everything is up to date, filed with the SEC. And if you're on the OTC market, often you're there because you perhaps are delinquent or you have been delisted. And there may be opportunities on the OTC marketplace, but those require a lot more in-depth analysis on your part. And in this case, we're building a portfolio using just basic quantitative rules, and we're not doing a lot of in-depth analysis. So it's very important that you get a diversified enough set of companies, and you want to make sure at least that you can trust the financials you're reading.
This sort of ties in a little bit about diversification and not allowing one bad event in a single stock to sort of torpedo your whole portfolio. But Harry asks, and this was actually in specific reference to Town Square Media, although it's not a sell requirement, what are your thoughts when you see a shadow stock either cut or suspend its dividend?
It depends on the situation. If it's because income is not a consideration, I think in the current market environment, where cash and the access to cash is critical, I think investors aren't necessarily, I'd say, penalizing companies that cut or suspend dividends to preserve cash, to make sure that they have, bullets to manage any kind of opportunities that come their way, and that they survive. I mean, I would rather have a company suspend its dividend and have the resources in play to come out of the economic environment that we're in now, than pay a dividend and run itself into troubles financially, or perhaps violate debt covenants.
Sort of getting back to some of the overall selection criteria. Kyle asked, how often in general are the market cap and price to book ceilings or floors adjusted?
Wade and I actually often will do like a analysis of that stuff on a regular basis, and we'll sit down at least quarterly and look at where the levels are. We look at them either using Stock Investor, or we'll go to the Fama French website, and he provides both price to book and market cap breakdowns by decile there, so you could look at them there. But we typically look at that stuff quarterly. We try to not to make adjustments too often, but it kind of depends on how much the market's moved as well. If you've seen a big market move, it's typically more likely to go ahead and have a adjustment to that level.
Bit of a loaded question, but Buck asks, reading a lot of research, I've even seen sort of an uptick in the number of articles lately over the last year or so talking about whether or not price to book is still a relevant valuation metric. And Buck is just curious to get your thoughts on your thoughts on whether or not price to book is still relevant.
I believe it's still relevant. The question is it still necessarily the best measure to use going forward? And that's probably something that we'll be pondering ourselves here. I think it's still relevant, but it obviously is ignoring I think a lot of your companies that have built up tech resources and have a lot of intangibles on there. We've done a lot of work at the association with what's called a value grade, in which we actually take a composite. And so I would be kind of curious to start incorporating some of those thinkings into the shadow stock portfolio in the future. One of the things that's always been kind of nice about the shadow stock portfolio over its history is that it's not a museum. It's not a historical environment. Over the years, we've modified rules, we've changed rules, we've added criteria, we've taken criteria away. We don't want to just jump on things without doing deep research. But if new academic research comes by that tells us it makes sense to add something or adjust something, I think the whole goal of the association is to learn from these findings and try to apply them in a way. So the rules are important, but making adjustments to the rules is also part of the process. It's supposed to be a learning portfolio. We're supposed to learn. A lot of the rules we have in place, as far as buy rules, sell rules, earnings adjustments, and things like probation, came about because basically we learned from our experiences.
No, I like that statement. It's not a museum. That's a great statement, John. A question that hasn't come through, but I know answering emails from members in the past is sometimes there's a little confusion with regards to a company that ends up on earnings probation. And once a company ends up on earnings probation, what ultimately needs to take place for us to remove it?
Yeah, if a company is on earnings probation, and that happens because it had its trailing 12-month 4-quarter earnings turn negative, and we're talking about adjusted earnings there, is we then monitor every follow-up quarterly earnings announcement. And if a company, let's say fourth quarter comes about, it had trailing 12-month, trailing 4-quarter earnings negative. If the next quarter, let's say it's the first quarter of the next year, earnings come out and they're positive, but the sum of the last 4 quarters is still negative, it's on probation, but it hasn't been sold. If on the quarter after that, earnings are negative, we would then sell it because we have both trailing 12-month earnings and the subsequent quarterly earnings that's negative. However, let's say that second quarter comes about and the earnings are so strong that the trailing 4-quarter / trailing 12-month earnings are now positive, we would go ahead and take it off probation and keep it in the portfolio.
Excellent. Excellent, very concise description of that. James asks, in those rare occasions where we lower either the market cap or price to book thresholds, do we basically tag or grandfather in any stocks that might have become automatic sells because we've lowered that initial threshold?
We have not done that in the past. We've typically just applied the new rules to the portfolio.
Okay. Let's see here. I believe actually we have, let me just double check here. Oh, actually, an interesting question from Byron. I'm afraid to buy microcap stocks because there's so little news on them. Is that a founded concern?
Well, as perhaps shown by the portfolio here, it's not a, I think it's, you have to be willing, I guess, to buy into a field of stocks that are in the shadows of Wall Street. And there's a lot of discussion as to why these microcap stocks perform well. One of it is greater volatility. The other element that's often been discussed by academics is neglect. And the fact that they're neglected may help indicate that they're mispriced. So I know it's difficult to let go of that situation where these companies may or may not be followed widely by the reporting services. But if you really want to try to take advantage, and if you want to spend your time researching companies, the amount of additional value that I could personally add by researching Microsoft is probably pretty slim. I mean, Microsoft is a very well-researched company. A ton of analysts are following it. It reflects the consensus of all of these opinions, a lot of opinions on Wall Street. However, if I take the time and effort to analyze a microcap company that may or may not have any analysts reporting earnings on it, the likelihood, the possibility of me adding value to my analysis is so much greater. And it's a difficult concept to want to let go of, but that's the whole premise of looking at these stocks that are in the shadows of Wall Street and that are potentially mispriced, not only because of their size and price to book, but because they're neglected.
And actually, we're a little bit past the bottom of the hour, but I think we have a question here that actually segs a little bit into some of the resources that you didn't have a chance to. And Dworka asks, where can I go at AI.com to see the current shadow stock portfolio?
Sure. Let me take just a few minutes here to highlight where our shadow stock resources exist. So if you go to our main website, and if you currently, this will change, but if you click on the premium services dropdown, you'll see a shadow stock area, or our homepage also should have a shadow stock link. It'll take you to the main homepage for the AI Shadow Stock. And if you do within there, if you click on the Model Shadow Stock Portfolio tab within that area, it'll show you the current actual portfolio. It'll also show you if there's any current probationary notes, or if any of the stocks are in danger of being sold because their market cap or price to book is too high. Furthermore, if you want to go ahead and just research some ideas and get a sense, if you want to build your own portfolio using the shadow stock rules, there's a tab called Shadow Stock Ideas. It's updated daily. 5 stocks passed today. These are the stocks that passed the initial rules for being a shadow stock. So they're positive earnings. The market cap is below 300 million. The price to book is below 0.90. Price to sales is less than 1.2. So these are all the basic criteria, initial criteria we might take a look at. The Shadow Stock Ideas gives you that. If you have any questions as far as what happened as far as the rules, if you want to review the rules, if you click on the Model Shadow Stock Portfolio tab, there's a section called Shadow Stock Portfolio Rules. As they change, they'll be explained here. And we write about the shadow stocks in the journal. you could go ahead and look at the journal commentary. Past articles are presented here, and the rate of return historically is presented here as well under year-to-year performance under Model Shadow Stock Portfolio. And if you have any questions, FAQs, some of the questions you guys asked tonight are very probably likely covered in these FAQs. If not, drop us an email. We'll make sure to add them to the FAQ rules that are up there. And probably lastly here, we have an email that goes out once a month at least, and also if there's any transactions that occur to the Model Shadow Stock Portfolio. If you go to the email preferences, you can subscribe to the Model Shadow Stock Portfolio update, and you'll go ahead and get updates sent to your inbox when anything of note happens to the portfolio, also when a commentary is mentioned online.
Well, thank you, John. Actually, I think we knocked out all of the questions that had come in. As always, you've presented some potentially complex investment theories in a very easy to understand manner. It's always a pleasure listening to you. So thank you very much for your time this evening.
Thank you, Wayne. It's a fun topic to discuss because it really, like you said at the beginning of the presentation, it really kind of hits at what we're about. And we're trying to take really quantifiable, solidly researched ideas and concepts and really apply them in a way that individual investors can understand and make use of. So it's been a pleasure, and I look forward to future events. I also look forward to toasting all of our members at our investor conference when the whole coronavirus thing is over, and we can go out and celebrate with abandon.
Excellent. Well, thank you once again, John.
Thank you.